Very good afternoon, friends, and thank you very much for joining us. My name is Ganesh from HDFC Securities, and the topic for today's discussion is PMS Portfolio Management Services. So, the volatility in the market continues, the uncertainty continues. But what are the opportunities for us in store, for us as investors? What is the way forward? What is the impact of the current events that we are witnessing right now? To give a perspective into all that, we have with us today Mr. Prateek Agrawal, who's the Chief Investment Officer and the Business Head for ASK Investment Managers Limited. Thank you very much, Mr. Prateek, for joining us. Welcome you to our show. Thank you very much once again for joining us. And without taking any more time, it's completely over to you now.
Sure. Thank you, Ganesh. Thank you, team HDFC Securities, for giving me this opportunity. Hi, everybody. Let me take you through our thoughts at the moment. Quarter 4 result season is progressing. There are very few spaces which have delivered growth. Most spaces have delivered degrowth. So the growth spaces are pharmaceuticals, telecoms, cement. That has done well. IT companies have overall done quite well. And I think 2 out of all banks and NBFCs have delivered growth. Otherwise, we have seen a result season till date which has delivered the growth. Index has delivered a 12% degrowth till date. And that then brings down the earnings expectation for FY20 to just about same levels as FY19. And given the fact that Q1 will be a washout quarter, FY21 earnings could be a degrowth over FY20. So what is happening is, even though the markets have corrected sharply from the top, we are still 30+% away from the top from where we are. But the valuations are, just about fair. We started the correction when valuations were probably higher than long period average. Now, after the correction, we are just about fair. Considering the fact that interest rates have dropped, maybe one can build a case that they could be a tad higher. So we are trading 19 times 1 year forward and 16 times 2 years forward. In the current thought process, what is happening is FY22 is expected to be a big growth year over FY21. Given the lower base effect, that should help that year. So the near term could be volatile, but there is some amount of valuation comfort in the market, especially for longer term investors. The comfort is even more if we look at asset-based valuation parameters. So on market cap to GDP, for example, we are just about 54%, while on an average we have been 78% over the last 10 years. So small point is, while the scenarios are evolving, while the uncertainty is high, valuations are now much more comfortable than before, especially for longer term investors. Now they should be lower than long period averages for to take into account the fact that in the current period uncertainties are so high. Now let me just talk about give you some numbers on how to read the markets going forward. So a 1 week lockdown, a severe lockdown like the ones we have seen, is 1.2% taken away from the GDP growth prospect. We have seen over 7 weeks of closures, 2 weeks of partial closure, and that means FY21 GDP could actually now be negative, 2% and then earnings could also be between 0 and 5% negative. If you see lockdowns getting extended, adjust the numbers accordingly. So that is the sense, that is the big uncertainty that we face. It gets difficult because as we speak, number of COVID cases are rising. We've crossed a lakh. We are among the top 10 in the world in terms of number of active cases. We are opening up, and that brings hope. As the economy opens up, as the factories start to hum, markets typically have been seen to celebrate. We do believe in India. While the demand is there, a lot of us are in homes wanting to get out. So demand is there. People haven't bought much over last 2 months. That helps. So there is that pent up demand. But the trouble is that production can come back only slowly. Though it will be steady, we won't see the dip that, let's say, country like China saw, because while they scaled up production, the consuming sectors were not ready to absorb the same. India being behind the world in terms of improvement, we believe as our factories scale up, the world should be in a position to absorb what we are producing. Of course, most of it would be domestic. Now, government has lent a fair hand. There has been a lot of packages which have been announced. The 20 trillion package has been announced. Lot of it was monetary. Lot of it was in the form of credit guarantees. Lot of it was in the form of deferred taxes. But yes, some bit of it was direct cash transfers to the lowest strata of society. The way it was done, there is just about 0.8% impact on the current fiscal. Rest of it is for the future. They are trying to make a small bit of money run longer, which is a smart thing to do, given the constraints that are being faced. So, to some extent, I do believe the packages have or should be helping address some of the near-term issues, while market would have been happier with a larger fiscal support rather than monetary and guarantee-based support that has been extended. In terms of the new spaces which have been opened up, the package has talked about a lot of reforms. Agri could lead the growth story back. Agri reforms, the APMC is being given bypass. People can now sell the produce wherever they wish to. The price discovery can be more dynamic. The middleman role would diminish. Mineral mining resources are being talked to be auctioned. This is something that was talked before, not new, but this is again being reinforced. And of course, privatization would be pursued. Apart from what was announced as a part of 20 trillion rupee package, there was something else the government did which was good, which is to put taxes on auto fuels, both petrol and diesel, and that could mop up in steady state around 1.1 lakh crores for the government, and that will be used for infrastructure. So this is something which has been missed by the street, happened before the packages got announced, but is a very, very big fillip to the infrastructure part of the economy. And I do believe we should expect to see momentum there getting sustained. In times like these, it is good to follow some investing check boxes. We are doing the same. Our portfolios reflect that. First checkbox is to invest into businesses with cash on balance sheet. Times are uncertain. The recovery is slow. If somebody has debt on books, uh, it will hurt. Interest will compound on money is not paid, and people who have cash can actually strengthen their presence in the marketplace. If you look at how markets have responded to companies like Bharti, where there may be stress, but they are seen to be winners in the telecom space. The stock price has done very well. Similarly, in the airline space, if you look at the various participants, and Indigo has tended to do far better versus others. And actually, similar is the case in the movie exhibition business as well, where while the uncertainty is very, very high, yet something like a PVR has done uh, relatively better than other names. Cash on book can improve positioning in the marketplace, and one should expect to see such businesses do significantly better than others. We do believe the premium, the quality part of the market commanded over the other part, hence could sustain and actually increase. Checkbox number two, investing into branded businesses versus commodity businesses. Now, this is a year where global growth would be slow. India could deliver a negative GDP growth. So, the world, one should expect, would do something similar. In this kind of a scenario, commodities should remain weak or be supported by very sharp production cuts. Now, both would mean, the earnings could be under serious pressure. Second, what we have also seen is a sharp drop in a commodity like oil. Oil has linkages across other commodities, so gas prices move down. If the oil and gas prices are down, other fuels can't be up, and so on. Petrochemical chain prices move down, plastic prices move down, all oil derivatives. So what happens is the users of commodity with pricing power gain margins. In FY21, if economy opens up, there's a fair chance that businesses like Asian Paints, Pidilite, Berger, paints and adhesive businesses which have oil as an input do deliver some growth in a marketplace which is starved of growth. So that is in the realm of possibilities. So I would say investing into branded businesses with strong pricing power is the thing to do in this kind of an environment. And here again, favor staples. We have seen how Nestle numbers have come. They've tended to be more robust than other FMCG businesses. What's over discretionary? In discretionary spends, we favor smaller ticket spends, cheaper base model manufacturers in autos, for example. When markets open up, we believe the top end of the market, the premium, super premium part, stays as it is. The top end retains their buying abilities. The middle end is where people will probably become more risk averse. The next level, they would strive to buy stuff like two-wheelers for personal transport, rather than going into trains and buses and shared transport. And maybe a segment above that will want to get into cars and go to places of work. So these are people who have actually not bought personal transport, for example. They are choosing to because they are now being forced to. So the sense is that they may just settle for the base models rather than the premium model. So uh, we do believe guys who make entry-level cars and there again the base model of such cars could do well versus other things. So that is the second checkbox. Third checkbox is domestic focused businesses over export focused businesses. Uh, we believe every country would focus more and more on the domestic market, protecting the domestic market so that their companies come back on stream, their tax revenues increase, and so on. We are seeing something similar happen in the country. The Prime Minister has talked about us becoming Atmanirbhar. And I do believe our export-oriented businesses will face the same in other geographies. Except the exceptions here being pharmaceuticals and chemicals, where given the times, we do believe strong demand to be there across the globe for pharmaceuticals, chemicals. There is this shift away from China that is benefiting the space. IT, frankly, given the positioning of India, the depth that Indian IT affords, in the near term, there is no substitute. We could actually see some benefit coming to Indian IT versus them getting negatively impacted. But apart from these, we do believe focus on domestic businesses should stay higher. We should again be amongst the faster growing economies, and hence domestic focus could work better. Now, in financial, someplace where the damage has been the maximum, we believe there are opportunities. Insurance businesses which used to be hard sold now have people wanting them. Life insurance, which is the highest, the pure term insurance kind of a product, highly profitable for a life insurance business, will have even more traction. In the general insurance space, the health insurance business with low penetration, higher profitability is seeing higher traction than before. As markets open up and people are able to get themselves medically examined, which is a requirement for these products, we should see faster growth. Lenders, again, if we segment them between corporate lenders and retail lenders, we believe retail lenders would again do better than corporate. Corporate would see stress in real estate entities, movie exhibitors, airline entities, all of them levered. Anything to do with the trade, tourism, hotels, kind of spaces. Uh, uh, and hence the idea is to stay away from these players. Retail side would also get impacted. Spaces like loan against property, spaces like two-wheeler finance could get impacted. There is a scare that even microfinance may get impacted. But my thought is that this is a part where government has lent a hand. There is some money which is trickling in to the weakest section of the society, and maybe they will be able to get back to their feet quicker. So microfinance, if it is focused more on the rural part of the country, which is less impacted, should come back pretty rapidly. Gold financing companies actually, are seeing growth and don't have asset quality issues at all, given that they are secured with gold and the gold prices have been increasing. In financials, which is a large part of the market and even our portfolios, it is a good idea to be with fee-based businesses, and in lending businesses be with retail-oriented businesses rather than wholesale corporate entities. This is what we have done in our portfolios, solid portfolios of companies which are having cash on book. So all of our non-financial entities have cash on book. We are investing into consumer-facing companies, not commodities at all. So 30+% of our portfolios tend to be focused on consumer-focused businesses, all of them branded and should benefit from gross margin expansions and small ticket, like I said. We are domestic focused except for pharmaceuticals and chemicals. And in financials, where we can, we have a significant exposure, 10 to 15% kind of exposure to insurance businesses. So these are the spaces that we believe stand out. These are the opportunities in the marketplace. I can add one more sector, which is cement. Cement is something which is a commodity, yes, but a commodity with pricing power. The manufacturing of the commodity is energy intensive. With prices of energy moving down, you should expect to see gross margin expansion in cement. Quarter four itself delivered margin increases. Logistic cost for cement is very high as well. So if fuel prices are lower, they could benefit on that end as well. It's just another matter that government took away a lot of that benefit. But quarter four benefit that we have seen in cement should continue in the quarter one as well. Government and rural India account for close to 80% of total cement demand in the country. So the damage to cement demand in 21 over 20 may be lower than other spaces. Barring of course FMCG, pharmaceuticals, chemicals kind of spaces. So that's the other space. So those are my thoughts on the spaces which could do well, which could find investor focus going forward. In terms of market performance, we made a point that we are fair to cheap on valuations while uncertainty remains high. Going forward, I think as people focus on quarter one results, which are going to be bad, practically, like something that we have never seen before. But then on the other hand, if we get improvement in the COVID trajectory in India, if we get a sense of a cure in the marketplace, that could be celebrated. Similarly, if the government brings in another package, that could be celebrated as well. And last, the biggest point being, when we spoke about FY21, we counted for quarter one to be so bad, and yet 21 earnings over 20 could be just a tad, 2 to 5% kind of degrowth. So that is the sense going forward post Q1. Obviously, sequentially, you will see a very sharp growth. By quarter three, you should expect to see YOY growth returning. Quarter two would be difficult. People coming back from villages to work, etc. But by quarter three, one should expect YOY growth to re-emerge. And as we go forward, quarter four and then quarter one, the YOY picture will look very, very good. Yes, there are uncertainties. Yes, there is some amount of valuation comfort. In terms of what we are telling investors is that they should stagger their investments into the market, not put everything at one go. Yes, put something now, but do stagger. Look at the trajectory of number of cases. If we see a peak out there, it's time to get more positive on the market. As we see quarter one getting discounted, by that I typically mean 10 to 15 results in quarter one FY21 getting delivered is the time when one should expect the market to have discounted quarter one earnings, and a big uncertainty would then be behind us, and that's the time probably to look at deploying some amount of money into the market. So I'll stop there. Happy to take a few questions.
Yeah, thank you very much, Prateek Bhai, for a wonderful session. It was quite insightful. So before we move on to the questions, can I also just request you to briefly touch upon the Indian entrepreneur portfolio, which is also our recommended fund from our side to our investors on the PMS. So if you can just briefly touch upon the IEP.
Yeah, sure. So IEP, what are we seeking to do for our investors? Our investors are investors who have made money. It is important for them to preserve that money and grow it. We seek to do that by investing into the highest end businesses in the country with an ability to deliver sustained growth. So this is something that we do across our house, across our portfolios. Now, how do we seek that growth out? Is different for different portfolios. In an Indian entrepreneur portfolio, the thought is that promoters, Indian entrepreneurs who have skin in the game, they have fire in the belly. They drive their businesses faster versus, let's say, professionally run businesses or government or MNC businesses. And if investors associate with such entrepreneurs, high in corporate governance, high in vision, then as these entrepreneurs make wealth for themselves, people who associate with them make money as well. We have run this strategy now since 2010, and it is a very, very disciplined strategy, filters based. Our whole thought process has been converted into filters to keep us super disciplined. So, for example, we define a promoter-run business with over 25% promoter equity into a business, with a small exception, if at all, being financials, whereby regulation you have to bring it down over a period of time. Second, we have a quality constraint. Anything that goes into the portfolio has to have over 25% return on capital employed. And this is the richest part of the market. The average for the index, which is the larger part in the listed space, has a ROC in the vicinity of 15%. So our threshold itself is an order higher, and then we want our businesses, to be able to grow strongly for not 1 year but multiple years. So we see compounded growth. Okay, simple thought is 100 rupee EPS becoming 120, becoming 140 as the time goes on, should get delivered in as linear a manner as possible. And this obviously increases the value of the firm, value of the business. Give market time, it will appreciate that, and the investors will make money. Over the life of the portfolio, we have managed to do an alpha of close to 10% over Nifty, with a very good risk character. So what happens is, if you buy businesses in the manner that I have described, this is the kind of businesses you want when the uncertainty in the marketplace is higher. So when markets are weak, when markets take a tumble, we typically fall by a significantly less amount, and this time is no different. unless of course our own part is hit by an adverse situation. So over last 10 years, there have been two instances where we underperformed the market when markets were falling. Else, every time markets fell in anywhere over 5%, we typically saw ourselves do much better than the marketplace. Uh, so that is on the Indian entrepreneur portfolio. Long period track record. It's the largest PMS portfolio in business, close to 10,000 crores now. Practically 45% of the monies that we manage, and continues to see very strong growth.
Great. Thank you so much, sir. So we will start
Thank
with
you.
the questions now. So I'll read out the questions one by one and then you can take it. Okay.
Yeah.
So the first question now comes from Mr. Jitesh. With so many businesses planning to and already moving from China, shifting from China, and trying to be self-sustainable, what kind of sectors or companies could benefit the most?
Yeah. So one, the businesses moving from China, while that's a great hope, till date very little to see on the ground. Businesses have moved to Vietnam, Malaysia, Thailand, Indonesia. We have seen only one company getting announced for India. We have seen Siemens and ABB say that they want to increase production given the Make in India stance of the government. Because these are companies which participate in government tenders. Railway is a government entity, and these are big participants in the railway business. So, for the fear of getting left out of that 200 crore filter of the government, some of the companies have shown interest in expanding manufacturing in the country. Otherwise, till date, the while there is a huge expectation and we should see a lot of success, but very little is seen on the ground. One second, companies which happen into India will be in the unlisted space, so investing into them directly would not be possible. But yes, what happens is if a lot of these companies come in, hopefully it happens. It actually improves the India consumption story by giving employment to a larger section of population. Steadier employment, which could really help consumption. Second, what it could also help is a space like cement, which will go into everything that they end up doing. So if they build factories, cement, steel are required. Infrastructure development, cement would be required. So I would say, for any big industrial activity to happen, it is from an investing point. It is better to be focused on consumption part, which will get a fillip. And if somebody wants to play capex, it is good to, let's say, play it through cement, where you have pricing power. Other commodities do not have the pricing power that cement offers. So those are the thoughts I would want to share.
Sure, thanks. Okay, so the next question is from Mr. Bhavin. Okay, what is the IEP? What is Indian Entrepreneur Portfolio Fund? What is the outlook for the fund for the next 6 months? Any growth percentage that you can share with us in your estimate? Probably I'll just add to that question, sir. I'll just add to that question. So with your Q1 and Q2 earnings, likely to be impacted, and probably longer than that also, how do you see that impacting the funds?
So, okay, let me try and give some sense. Whatever is my expectation for the future. So I made a point that 21 over 20 would look actually a degrowth here. If we look at our portfolios, even if the index earnings are, let's say, -5, even up to -7-8%, we should still be 0 to +5%. So there is this delta in earnings, which we definitely hope we will be able to capture because of our focus onto stronger businesses, spaces like chemical, cement, pharmaceuticals, insurance, and even in lenders, some of the better, larger private sector lenders. So we do believe our earnings growth would be tad higher. Our part is a part where we have seen severe valuation correction because while index earnings has been flat, we hope to still deliver between 20 and 30% earnings growth for our various portfolios. And our performance, while it has been a bit better than the index, yet because of earnings growth, valuations have corrected very, very sharply. I had made a point that market polarization could actually increase going forward, given the fact that cash on book businesses can increase strength in the marketplace. If I look at how 22 would be over the present, we do believe 22, the financial 22 can be a strong growth here over financial 21, given the pent up demand and the low base effect. And on the index itself, one should expect more than 10% return as 22 starts to get seen. And I would say in the same period, given our superior earnings growth trajectory, our portfolios should end up doing significantly better. So that is the thesis I have for our portfolios, including an IB portfolio.
Great. Thank you, sir. So the next question is from Kanchan. Okay, interesting. What in your estimation would be a reasonable time frame to recover from the current losses that we faced?
Yeah.
So,
correct. When do we get back? So if I rephrase the question, markets would be back to where they were if earnings are back to where they were. So 21 could be a bit of a degrowth, 22 a stronger growth, and beyond should be a similar growth trajectory versus if COVID had not happened. So I would say a year, and we should be back to where we were. Maybe a tad longer than a year. That is my expectation at this juncture.
Great. So we'll take the last two questions now for paucity of time. What is your view on the real estate sector at the moment by Rahul Singh?
Yeah. So real estate, I think the lower, the cheaper homes should continue to do well. The benefits extended to them have been extended by a further 1 year. So that helps. The interest rates for homes have been brought down, and we are now at levels that we, I think, last saw in 2002, if I'm not wrong, 7% for home loans. 6.75 is also possible if you do a repo linked loan. Housing prices have come down, so don't go by the sticker prices. I think 20% discount to sticker prices is a done thing. And in combination with 6.75 to 7% interest rate, homes are more affordable today than they were for a very, very long period of time. Last time this combination presented itself in 2002, where again, 98 to 2002, there were no increases in home prices. and we saw the market really do very well over the next 3 to 4 years. You know, if 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 the insecurities that have come in because of COVID, people have lost jobs, people have seen wage cuts, etc., are quickly reversed, and these things do get reversed very quickly. We should actually be positive housing rather than negative housing, especially for housing which is fully built. The character of the business has changed. I don't believe too many people will want to buy a house which is under construction, given the uh, you know given what people have suffered over past several years. Delays and delays, and not being able to get in the possession of the house. But so the builders will have to build their own houses full and before selling. So the ready inventory should see a lot of traction. What is still under construction, I think the stress will be more. Coming down to commercial, which is a more tricky question, both could happen. There can be more demand for commercial as people from abroad want to look at cheaper destinations like India. The other big driver of commercial could be distancing. So, in most offices, people don't have a 5 feet distance between two individuals who are sitting. And even if half the office is told to work from home, even then maybe the 5 feet distance may not be achieved. So there could be more requirement for commercial space also going forward, even after taking into account work from home. So that is how it is. Initially it will be soft because a larger percentage of people will work from home. Very few will come into the offices. But as office population starts to increase and COVID continues, the COVID is not going anywhere. We will have to adjust to it. I think the distance between two people, if it is higher, we will need more office space. So one should not be very negative on that space, but yes, the best of the names and people with ready-built inventory are the guys to look at, not everybody.
Okay, thank you. So we go in for the last question for this session, which is from Mr. Ravi. What is your outlook on PSUs?
No, so PSUs span a large this thing. So some of them are very good. Many of them will benefit from government focus on making things in India. Many of them are, let's say, discovering themselves. So let's say a BHEL, which was doing boilers, turbines, etc., for coal-based power projects, which are no longer in demand, is reinventing itself, is trying to open up for alliances with other global players into newer areas of business. They are trying to find their place in the marketplace again. Coal India, the resource kind of PSUs, they are evergreen. We will continue to need what they produce. As of now, they are monopoly. Private competition, when it comes in, still time. So those are spaces which are still okay. The problem with PSUs is the stock price performance, not the performance of the company itself. In many cases, performance of the companies have been good, but what is happening is the NTPC, for example, continued good performance in a period of falling interest rates. A fixed return business should actually be valued significantly higher. However, in many cases, the theory has not played out because of continued selling pressure from the government. That has been an issue. While in many cases the operating parameters could have been quite good actually. I think till the government really becomes strong on its finances and can opt to not sell its holdings in a desperate manner. Till then, as an investment, it would probably be less attractive.
Great. Okay, so that brings us to the end of the session. Due to paucity of time, we'll have to stop here. Thank you so much, dear clients, for taking the time out and joining us. Thank you so much, Prateek Bhai, for a wonderful session as usual.
Thank you.
Okay, and we look forward to interacting with you with all our investors once again. Thank you so much.
Thank you.
Shyam, we can close.